Hello and welcome, everyone. This is going to be the first ever ATC podcast. My name is David Torres, and I've been a student at ATC for about 3 years. So, the goal of this podcast, simply put, is to break down what it means to become a professional day trader, more specifically, professional tape reader. This is going to be a conversation between a master tape reader and a student. We will be diving into topics through the lens of the tape, specifically psychology, market makers, retail traders, our 1 through 4 setups, and much, much more. So without further ado, it's my pleasure to introduce Rich Lepis, the founder and CEO of ATC. He has developed this tape reading methodology and has been tape reading for over a decade.
How's it going, Dave?
Not too bad. Excited for this first ever podcast.
Yeah, I'm definitely looking forward to really kind of expanding into this. I know we're really going to be focusing on tape reading. Obviously that's what we do here at Ahead of the Charge Trading. But we're definitely, like I said, looking forward to getting out this content and really kind of diving into a lot more specific topics. We do our weekly class called Traders Exchange each week, where we kind of let the students give us, any type of question that they have on a specific stock that they're trading, or really any topic in general. But we're going to really focus in on the things that we see during the day, kind of, getting a little bit more advanced than we would in, that beginner type questions. So definitely looking forward to it.
Sweet. Let's just jump right into it. So jumping right into the tape, our first topic is a market maker shorting versus a market maker building. As tape readers, we have the distinct edge and advantage to view supply and demand, which sounds simple in theory. You follow the side where the smart money shows their hand, and you just follow their shadow, it's true, but it's not as simple as it sounds. So with this topic, we're going to be looking at it through the lens of a long trend. So how does the tape tell us if a market maker is setting up for a large short trade if the stock is on an uptrend?
Well, just to start off, like you said, it's kind of funny because, yes, time and sales is the buying and selling. We all know that the market is moved by supply and demand, but it's not just seeing buying, understanding exactly, the stock is just going to be going up, and seeing selling and expecting a stock just to go down. So that's one of the cool things that we're going to be doing in this podcast, is really kind of digging in a lot deeper into the psychology behind what we're actually seeing and why it moves the way it does, and kind of almost telling us the timing of when it's going to move when it does. So talking about an uptrend, so just a stock that's continuously going up, kind of deciding almost a trend change and seeing when the stock, someone's going to be looking to actually be making money to the downside versus being able to bring the stock down to build more to end up continuing that uptrend. And there's really two main differences between it. So when a stock is going in an uptrend, essentially what the market maker is looking to do is make money long. So they have their long positions, and the more the stock goes up, the more that they're going to end up making on their actual position. But how often do we actually see a stock just go straight up?
It's not very often. If it wouldn't work like that, it'd be simple.
Yeah, exactly. I mean, it's just most of the time what we're going to see is we're going to see these dips and we're going to see these valleys within the actual chart. And when a stock is going straight up, a lot of the times what's actually causing those dips and those valleys is an exorbitant amount of buying. So what's going to happen? Let's just use the number 10, for instance. So just, to kind of give an example, we see a stock go from, let's say, 9 to 10. When we come into 10 and we see a huge amount of buying at that 10 level, really what that market maker is telling us is that they're looking to build a bigger position. And what I always tell the students is it's essentially it's the tip of the iceberg. So when they show us something that really stands out, that's only part of what their actual game plan is looking to do. So when we go building versus shorting, just because a stock is going down, it's not essentially telling us that the market maker is looking to make money to the downside. What they're actually looking to do is build more shares, bringing it to the downside by taking money from retail traders. All right, we've all, got into a stock before, and all of a sudden it seems like someone's sitting behind us, and immediately getting into the stock, it ends up coming right back down. And that's because there's really two situations that market makers allow us to be in. The first one is they allow us to give them our money. we know that trading has a very high failure rate. And the reason they know this is because they know exactly where retail is going to be in a certain stock. I use the number 10 because it's really kind of a psychological level, which is telling us that once it breaks past that point, all retail traders are trained in support and resistance. So they see that kind of psychological level. Once it breaks above it, they think that it's kind of a safe haven where the stock isn't going to be able, it has that support level to be able to stay up above it and be able to continue on within that trend and continue on within that buying. But that's exactly what the market makers want us to think. So when they're looking to build versus short, when they bring the stock down, they want to use as the little amount of shares as they possibly can to bring that stock back down, because they're building an overall larger position. And of course, to make us, as a market maker, to make a stock go down, they do have to use some shares, but you're not going to see as much. And the thing about understanding building is that when they bring it down, it's not for them to make money. We're under the assumption as tape readers that all market makers that we see come into a stock are going to have to make money. I always make the joke about it where if they're not making money, they're going to end up being fired and someone's going to come in and that is going to make money. So we're always under that assumption when we see our prints, especially if, for instance, ask at 10, that someone's got to make money, the stock needs to go above that 10. But during that building phase, they're not, like I said, they're not looking to make money yet. What they're looking to do is bring it down in order to steal shares. And I'm sure you've been in a situation before when a stock starts to come down. Let's say you're in a trade and you see a stock either take a kind of a sharp, turn towards that downside or breaks past the support. What do you typically do?
I mean, just from the retail mindset, they don't see the tape like we do. They don't know the difference between shorting and building. So regardless, their reaction is going to be the same consistently. So they're above that psychological level. They get a sharp bar down. You're getting out. You're out. You're done.
They're going to be looking at sell exactly. And during a building phase, guess who's going to take those shares?
That market maker is going to snatch those right up.
Of course, because then after they acquire the amount of shares that they're looking for before they make that money over that 10 level, then they're going to release it. And that's once again what all the retail that's been in a trade before, they get out and then the stock does exactly what they thought it was going to do. We've all been there at some point during our trading careers, and that's exactly how this happens. Now, the other side of things is, what about if they're actually shorting? And the easiest way to think about it is that now they're looking to make money towards that downside of things. Remember, when we talk about building's coming down to acquire more shares, and unfortunately, for the most part, it's coming from retail traders. And then when they're shorting, they're looking to actually allow the stock to continue on its way. So when I talk about, the two different situations, again, it's they either allow us to give them our money or give them our shares, which unfortunately results in a loss for retail. And on the other side of things, they also do allow us to help us as retail to bring the stock to where they're looking for it to go. So in this case, what we're going to start to see is, well, like I talked about before, in a building phase, we're going to see them try to bring it down on as little selling as they can, because the more shares that they give up, okay, the more shares they're going to have to acquire at that lower point. So what happens is that if they're really looking to short, we're going to start to see positions, actual selling positions that are coming in near those highs. And it's going to be abundant in comparison to if they were building. So if we see a ton of buying that's coming up, we're going to start to see kind of a change in the money flow. And we're going to start to see that selling, those bid prints that are going to be coming in towards the highs. And it's not always going to be right at the high, but as it's coming to where it's looking to go, and psychological levels are perfect spots for this again, because, it's just a lot of retail is going to end up selling or looking to short once a stock breaks a psychological level. So we're going to start to see that selling coming in, and as they kind of build that shorter term position, or that almost that day trade position, we're going to see that trigger that ends up coming down underneath a level that brings it to where they're looking to short it to. And the way that we know where they're looking to short it to is based off what's called print personality. So a print personality is that if we go through time and sales on prints that are above 1,000 and in between 10,000, we can kind of see what I call bursts. And these bursts are what an average position of a market maker looks like. So based off the amount of selling that we see, we can start to kind of get a calculation of how many levels based off of that selling and how much selling there is, of how low they're looking to actually bring the stock. But again, it comes down to the biggest difference is when they're building, they're not looking to make money yet, they're looking to acquire. And when they're actually shorting a stock, they're looking to bring it to where they think it's going to go to then end up covering. So the same thing when we see that selling coming in, one of the best ways that we can know that they were shorting and that the stock is coming to a point where it's not going to be able to continue anymore is we're going to start to see that buying coming back in. So let's just say, and it's impossible unless, basically you're Rain Man, it's impossible to calculate the exact amount of shares that are being short compared to the exact amount of shares then being covered. But we can still have a great idea of it. So if we see 5, 6 bursts of these selling prints that are coming in, once we start to see kind of that 5 or 6, burst of buying prints, then we start to get that idea of that's where they're going to be looking to end that short. Because again, even if a trader's looking to short or they're looking to long, it's got a shelf life on it. It's got a price target. We don't just see a stock just go up forever and a stock just go down forever. So by understanding these differences within the tape, we can really start to kind of understand exactly what that specific trade that we're going to be following, because that's all we do. We really just follow the market maker's prints. But we can really understand exactly what that market maker's intentions were for that specific trade.
Right. So how do we take advantage of this thought process on a longer term time frame? I'm saying maybe week, 2 weeks out, because we see multiple times we have stocks that build for a period of time and then they break out. They become exceptions. They run. They blow past multiple psychological levels. They blow past their average range for the day and don't end up pulling back to build.
Mm-hmm.
How do we use and understand essentially them setting up for the phases, so them selling and then starting to short in the longer term time frame? Or how do you approach that as well? Because I know, not LCID, yesterday it had a profound day and it ended up not pulling back through 50 and 55, two huge levels. And then today we ended up getting a significant amount of sell and then some shorting that was also within that. So how do we use that longer time frame to benefit our own day trading?
Well, so a lot of that is, if we're talking about exception trades, a lot of that's going to be coming within the personality that we're starting to see the prints. So we always talk about print personality. If, let's say, for instance, it's just 5. So in a typical burst from a market maker, we have 5 ask prints. If we see 5 ask prints go through multiple levels and over 5 ask prints, and it shows that they should be building, but they're not. At a certain point, there's going to be enough off-level prints that we're going to start to see. And what I mean by off-level prints is that it's a print that's essentially, so it could be 1 cent, 2 cents, 3 cents, 4 cents. It could be 6 cents, 7 cents, 8 cents, 9 cents. Nothing at zeros or fives. We're going to start to see a lot of those prints come in as the stock is making its move. Because what those tell us is that this is the shorter term side of things. The reason that we always look at major levels, and what major levels essentially are 50 cents and $1. But why we see a stock that shows us prints that should end up pulling back and it doesn't, is because we see too much of the money flow side of things going one way. So a pullback doesn't just happen to happen. There has to be some type of catalyst that's going to spark it. And there's really 2 different ways that that's going to happen. So they can either do it with, let's say, again, we're talking about an uptrend, but let's say that we're talking about a stock not pulling back. And if the stock's not pulling back, we're going to start to see these catalysts that are coming into it, because they can either pull it back with actual selling if it's on an uptrend, or they can actually pull it back with orders. And with the orders, the way they can pull it back with orders is that the definition of a market maker is having 100 shares on both the ask and the bid of a stock. So if the dominant market maker that's in control of the stock wants to take the bid, for instance, and drop it 20 cents, the actual stock itself is going to drop 20 cents. So they can use either the orders or they can actually use selling if they want to pull that stock back down. But what we're going to end up seeing in an exception is we're going to see a money flow that is way, especially in an uptrend, is going to be way leaning towards the buying side of things. And not only are we're going to see off-level buying, but we're not going to see much off-level selling. Another really great way to look at it is the personality of the stock during the pre-market. So during the pre-market, we can tell a lot about how a stock is printing and what their expectations for that day is going to be. So for instance, yesterday, and we'll talk about LCID, before the market even opened, what did we see print-wise?
Yesterday was just a ton of accumulation.
Just all buying during the
Yeah.
pre-market. There was absolutely, I mean, there literally was no real big selling that happened from essentially from 8 o'clock in the morning all the way until 9:29 when 9:30 when the market opened. So it was really giving us a setup for what their expectations for the day were going to be. Because the pre-market typically isn't going to have, well, it's almost always, it's never really going to have, unless it's, when we're talking about a hot stock, it's never going to have more volume during the pre-market than it's going to have once the market actually opens. So we got to think of the psychology behind what they were actually doing during the pre-market. Why would someone come in and just buy and buy and buy and buy, especially with that low of volume where everyone can see it, if they didn't really know that the stock was going to continue and have one of those epic days where it just an uptrend, barely any pullbacks, and really have a huge range in comparison to what it typically did? So another tool that's wonderful to use is what the prints during the pre-market, because they showed us nothing. What would be the only reason, if you think about it, that you would have to buy that much and show everyone you were buying that much? Because during a low volume time, the prints stand out like, basically like, blinds. If you have like a crease in one of them, that's all your eyes can go to. So during the pre-market, those prints stood out big time. What would be the only reason to have to acquire like that?
There's no other reason besides they know for certain where the stock's going to go. So we can use the pre-market to really judge and gauge whether a stock is going to enter in a possible exception time.
Oh, 100%. And the thing is that you can't do it with every stock. So every stock during the pre-market isn't going to show you something where it has more volume that it's going to be trading. It almost looks like it's trading during the open of the market already.
Right.
So there's some pre-market trades where you're not going to be able to tell that at all. But when we're talking about exceptions, one thing about exceptions, it's guaranteed if a stock's going to be an exception, almost guaranteed that you're going to have huge volume in comparison to what it typically trades on average. So when you see something like that and you see just tons and tons and tons and tons of buying, they're obviously doing it that quickly and showing everyone because they know what, the game plan of what's going to end up happening. So on an exception stock, when you see something like that, it works the same exact way on the other side. If you were to see just tons and tons and tons of selling and no real buying coming into it, we can almost expect that we're not going to get a lot of pull-ups on the way down because of how much selling is actually going into it.
Right. And that feeds directly into the second topic that I had, which was understanding the logic behind exception time, which is a stock not giving full pullbacks and obviously running. So as students, we learn to master following our rules. So I think that's what we mainly focus on is, okay, on an average day, this is what a stock should do on average. And we have that in our mind. That's the game plan we create. So for example, we get as prints above print personality at a major level, we should get a pullback that is calculated based upon how much they purchase at that level and our increments. So that's obviously on an average day. But how, as students, do we master trading exceptions? How do we adjust from our expectations of an average stock to an exception stock? Because I feel like personally, that's what's holding a lot of students back, is really that transition from average to exception and being able to have that click instantly. Because I feel like students are just so caught up in like, okay, these are the prints, this is our expectations, this is what I'm going to trade, but they're missing the whole other picture of like this volume is exceptional. What they've done in the pre-market, what the market makers are showing in terms of the volume and what they've done previous in terms of building. So how do we switch our mindsets from this blanket statement of aspirants this level needs to pull back and transition into molding our mindset around what the personality of the stock is, and then from there finding our 1 through 4 setups?
Okay. Well, the first thing I do want to start with is that a stock should always be treated as a rule until it's proven to be an exception. So there's a few things that can go into understanding what, and basically being able to anticipate when a stock could be an exception. And the number one thing is going to be volume. especially if a stock doesn't typically trade that much in the pre-market and you have just a big pre-market day. That's almost one of the key aspects of things that you want to take a look at and be ready for that stock to be an exception. Because the higher the volume, the quicker it is for them to be able to build. So if the quicker they're able to build, the less that they need to actually bring a stock down for a pullback. And that's, that's going to affect and make it kind of become more of an exception, because they're always going to still be building, but they're going to be doing it very quickly because the amount of volume is allowing them to be able to do that. So that's one of the first things that we do want to look at. Now, again, off-level prints, that is a huge factor that's going to come into understanding if a stock is looking to pull back. Okay, we want to see if a stock prints, at, let's say, the 10 level again, and we see that it gets huge prints that are coming in at 1001, 1002, 1003, and they're almost kind of leaking over. It's telling us that they're buying as quickly as possible at that high amount. And if they're telling us that they're looking to buy that much that quickly, what are their expectations? Well, it's not to pull back and then build trades. It's going to be for the stock to actually be able to start running. So that's another huge factor that we're looking at. Again, personality of pre-market. When you see something that just jumps out at you, okay, the buying or selling, whether it's an uptrend with buying or a downtrend looking at that selling, if it's just completely jumping out at us during the pre-market, and they're just allowing us to see that much, that sheer amount of buying or selling that's coming into it, and we're seeing the money flow 90%, and let's say we're talking about an uptrend, 90% buying and 10% selling. Another one that we can almost guarantee, because they're looking for that stock to be able to go and really kind of run its way up. Now, I'm going to give a kind of just a little bit of a, I wouldn't call it a tip or really a trick or something like that, but almost more of a setup. My favorite type of trade, especially when you have a stock that doesn't, and this is in the beginning stages, because screen time at the end of the day, understanding, almost allowing the time and sales linked to the chart to go into your subconscious. Screen time, there's just something, you can't pay for screen time. It's just being there and seeing the same things happening over and over and over again. So instead of mastering an exception is more almost kind of feel based off of the prints that you're seeing coming in. Now, I can give you, these solid examples and everything of what you can look for it, but it's mastering an exception isn't something that's going to be done in 6 months. It's something that's done in a year, and unless it has these blatantly obvious factors that are coming into it. But one of my favorite setups is don't try to trade the exception. All right, because if a stock, let's say it prints at a ton, let's say at 10, then 11, then 12, all these ask prints coming in at these levels are telling us that it needs to pull back. What's going to happen is the stock, no matter what, a stock needs to follow its rules. But rules can go for an extended period of time before they actually are followed. So I wouldn't look to try to, especially the beginning stages, if you're, a year or 2 years into this and you don't really have those, that 1,000 hours of screen time that's came in, just kind of turn your mind away from that and don't worry about the actual movement that's happening with the exception. Because what's going to happen is that when a stock doesn't follow multiple levels, when it eventually does, it does it all at once. So you might have to sit there and you might have to go through more of a time period of watching rather than trading, because at the end of the day, we're not trading constantly. Okay? We're doing about 80% watching and about 20% trading throughout the entire day, because we got to find our setups, we have to find our prints, so we're doing a lot more watching than we are actually trading. But if a stock is now $5 away from where it really needs to pull back, one of my suggestions, especially for a new trader, would be, instead of trying to trade that exception, wait for that trade where it all happens at once. And what's going to end up happening is, when it's time, it's going to be completely obvious. It's not going to just slowly end up coming back down. You're going to get what we call a trigger, which is going to be a bar with huge volume and price action that is essentially going to start the entire pullback all in one trade. Not only does that allow us to get far away from the price, the price target that we're looking to get to, so it gives us a lot more range within that actual trade, but it's a lot more obvious. And when those happen, those are huge trades. And this way, you don't have to go against the rules in this scenario. you're following them, but it's just all happening at once. And it makes for really being able to get far away from your entry as quickly as possible.
Right.
So,
So
a lot of it, like I said, is screen time, but in the beginning stages, that would be my suggestion.
Right. So what about from the perspective of we get this stock, that's an exception, and then throughout that whole day, we never get that reality check bar where it happens all at once, and then we proceed into the next day. What is your mindset going into that pre-market, and are you completely in a new slate and you're looking for completely new information, or do you have in the back of your mind, okay, yesterday, 2 psychological levels never pulled back from, I knew it was an exception. How do you approach that day?
So if let's say the stock is let's say it moved, I'm just making up numbers here, but let's say it moved $5 up, never pulled back throughout the entire day. So the range from the top to the bottom going straight up was $5. Essentially, the conservative price target would have to go down to the original level. It really should pull below it. So if it moved from 10 to 15, essentially it really needs to at some point build under 10 because that's what they told us. But because that day it was an actual exception, it did not do that. So now we know that a stock that really should move $5 back down for a pullback. There's no way in the world that we're the only people that know that. There's market makers that are way better traders than I am out there that know exactly, they're making the market. They're going to end up bringing that stock back down. There's no way that they're letting it move $5 without shorting it. Someone's going to be making money on that. So I have that in the back of my mind, but to an extent, it's still kind of a clean slate because I know I need to see that selling. It's possible. It does not happen very often, but for the most part, but it's possible for stocks to run days as an exception.
Right. I mean, we have seen that with AMC, right? It just becomes a crazy exception.
100%. We look at, especially you could go back to like those Reddit stocks. You could go back to what was it, DWAC, where you had these stocks that just continued to run, but those days we never saw the people coming in to really sell, to really short it. So I have that in the back of my mind, but until I have somebody to follow, I want to see some, because if the stock's going to move that much down, I know that there's going to be somebody that's going to short the hell out of it.
Right.
So I need to see that first before I can just, assume that a stock is going to end up pulling back. Now I'm going to tell you something. If you look at most stocks out there, there's way more stocks that are going to be an exception for one day than there are going to be, ones that are for 5 for 10 days. So the next day is definitely, is real important to focus on looking for that selling. But it could happen. But you'll see you're not going to get those positions, those shorting positions coming into it on the day if it's going to continuously run on its way.
So no matter the time frame, we're always going to see the individuals to come in, the market makers, to tell us that they're going to ride that pullback, right?
Yeah, there's never a stock that's going to move a substantial amount that someone doesn't know it's going to move it and make money on it. It won't happen.
Yeah. Well, that was a solid introduction to our first podcast. I think the viewers would get a lot of information on the two topics, the market maker shorting versus building, and they kind of fed hand in hand to each other as well, right into the exception trade. And I know many of our students as well have really been, they don't know how to formulate the questions when it comes to exceptions. So I really hope that they gain a lot of information out of this.
Yeah, no, and we definitely at some point will continue on the exception point, but we got to start somewhere.
Yeah.
Got to start with kind of that foundation first. And as we continue on in these episodes, I look forward to getting more in depth into each topic.
Well, thank you, Rich, for your time and helping with these topics. If you guys have feedback on anything, please feel free to comment in the comment section, message me or Rich. We'll definitely use them into consideration so we can improve this podcast. Have a wonderful night, all.
Dave, it was a pleasure. I'll talk to you later.